Webinar on planned giving. I'm Dennis Lambert, host of Morning Edition here at KJZZ for the last nearly 20 years. Many of you probably only know me from radio, but this is what I look like, live and in color. Before we get started, I have some housekeeping notes to share. Note that Firefox is the preferred browser for GoToWebinar. If you have any questions, please feel free to contact us using the following methods. Question box. Please use your estate planning questions via the question box of your dashboard. If we don't get to your questions during the webinar, we'll be able to respond through email. Chat box. You can use the chat box for other comments or questions, but please note that group chatting is not available. All chats are direct messages to the staff. On email, webinars@kjzz.org. And for technical assistance, you can call GoToWebinar support line at 888-259-8414, 888-259-8414. Panel discussion is going to last for about an hour, but our volunteers will be on board to answer your questions until 8 tonight. Before we get started, let me introduce our panelists. Beth Cohn is a shareholder of Jayberg Wilk. She chairs the firm's estate planning, succession planning, and probate departments. Beth is a tax specialist certified by the State Bar of Arizona, Arizona Board of Legal Specialization. Her expertise includes structuring business entities and succession plans, allowing clients to take advantage of tax and business opportunities, as well as protecting individual business owners' assets from the reach of creditors. She currently serves on the Tax Law Advisory Commission for the Arizona State Bar. Ronald Wilson is with Morris Hall. He has worldwide experience and education in estate planning and trust law. Ron is a member of the American Academy of Estate Planning Attorneys, as well as a member of the National Academy of Elder Law Attorneys. Ron has been active in the estate planning industry, serving as past president of the Arizona State Bar Probate Section and the Central Arizona Estate Planning Council. Stephen Taddy is co-founder and managing member of Stellar Capital Management. Steve has over 30 years of professional experience in the investment field. He's worked with a select group of clients ranging from publicly traded corporations, government entities, and Native American Indian tribes to high network individuals and families across the country. He's currently a member of the National Association for Business Economists, a panel for the NABE Outlook National Forecast and the NABE Financial Industry Roundtable, the Western Blue Chip Economic Panel, and a member of the Arizona Legislative Finance Advisory Committee. And Laura Barton is the Planned Giving Officer for KJZZ and KBAQ Public Radio. Laura's role at the stations is to provide support, opportunities to engage and work with listeners who have interest in extending their gifts into the future through planned giving or estate giving. She's an active volunteer with the Maricopa County Court-appointed Special Advocate Organization. Now for our questions. You hear the term planned gift. What does that mean in terms of my charitable donations, Ron?
Good evening, Dennis. A couple of years ago, I assisted a local charity in putting together a planning guide. And one of the first things they wanted me to do was to define what is this term, planned gift. So what I came up with, and I'm going to read if I might, that says, one which is legally provided for during the donor's lifetime and generally regarded as having been made at a particular date, but its principal economic benefits are not received by the charity until a later date, usually at the death of the donor or the death of another beneficiary if one is named. This sounds kind of highfalutin, but from a practical standpoint, a planned gift is simply a gift, first of all, and number two, it's planned.
Is there any, obviously there's not a restriction on when you can give or who should give, but a lot of people are going to say, maybe I don't have all that much money. Should I be worried about planned gifts?
Good question. All of us have to be concerned with long-term care issues anymore. And will there be money, left? And so what happens on many occasions is they may make a small donation to their favorite charity during lifetime, but yet in their will, with their trust, their life insurance, their retirement plan, they're saying, hey, look, if there is money left over, I want my favorite charity to get X dollars or X percent. So it's an opportunity then to accomplish both of those objectives.
Steve, what's strategic securities gifting?
Strategic securities gifting is simply using a gift to rebalance a portfolio. For example, many individuals may hold securities for a long length of time, and they've appreciated enormously over 10, 15, 20 years, it's an opportunity to reallocate the portfolio without incurring a tax on the gain nor commission on the sale. It's a great way to reduce the weighting in a sector, an industry, or a position.
Beth, may I give stock to my favorite charity and reserve an income stream for my wife and myself during my lifetime?
Dennis, there are some very good planning opportunities with stock and making gifts to charities. And I think one thing that we have to distinguish is because stock has two different flavors. There are marketable securities, which are traded on a stock exchange, and then there's the stock in someone's closely held business. So just for this discussion and because of our limitation of time, I'm going to talk about the marketable security. So it's not uncommon that somebody has a stock that they bought at a very low basis and it has gone up significantly in value. And if they sell it, they're going to have a really large capital gain. So one thing that they can do is that if they want to gift that stock to the charity, they can make a gift, and then the charity sells the stock, and then the charity does what's called a charitable annuity, and the annuity can be paid to the donor and the donor's spouse for their lifetimes. That's kind of the simplest form of this. And if you get into more sophisticated planning, you can do what's called a charitable remainder trust. So the stock is put into this trust, and it's a trust that's approved by the Internal Revenue Service. And in the trust, you have actuarial calculations, and these calculations have a, you pick a term of years, not more than 20 years, that you can reserve an annuity for yourselves, and that at the time you place the stock into the charitable remainder trust, you value this term that you're going to receive the annuity, and then you also value the remainder interest that goes to the charity. And at the time that you're making the charitable deduction, or actually what you're doing is you're putting the stock in this trust, and you're making a charitable deduction of the value of the remainder interest to the charity. So we're limited by time. We don't have, the ability to talk about this in more detail, but these are vehicles that, our listeners can discuss with their planners.
How would a gift like this to a charity affect the capital gains taxes I might otherwise be hit with?
Well, you're not going to pay the capital gain tax, because if you give the stock to the charity sells the stock, and they're tax exempt. So you're not paying the capital gains tax. Also, once you contribute the stock to a charitable remainder trust, and the stock is sold by the charitable remainder trust, that's also a tax-free transaction. So you eliminate the capital gains tax. You have a reduced charitable deduction because it's appreciated property, which is limited to 30% of your adjusted gross income. So you have to really also work with your CPA, because there's a lot of individual income tax consequences, and people also have to be concerned about the alternative minimum tax if they have income that is of a level that the charitable deduction may trigger that.
Laura, I've heard that I can make a charitable donation directly from my IRA. How's that work?
Well, it works very easily, and it's particularly valuable for those persons that reach 70 and a half years of age or older, and they have a required minimum distribution from their annuity. There are several ways they can do it. The gift total must be $100,000 or less. The charity that they pick must be able to receive tax-deductible contributions. The charity is not to be a Section 509A3 supporting organization. That cannot receive the IRA. The withdrawal is required to go directly from the annuity, the IRA, to the charity. That is one of it. It doesn't have to go to the charity's bank, but it has to go directly to the charity from the IRA account. That's one that people frequently are concerned about. Charitable distribution must be made by December 31st, and we're awaiting the signature from Congress that we can do it again this year in 2015. Last year in 2014, I don't think the bill was approved until about the 15th of December. So I've had a number of calls and people are preparing for this, but it must be made by the 31st of 2015. The donor does not need to itemize their taxes. Itemization requires the donor can't also take a distribution as a charitable deduction. So what they give, they don't pay taxes on.
And just a reminder, there's a group of professionals available to answer and take your questions for the group, and you can reach them at webinars@kjzz.org.
Excuse me, can I just add just one comment? Did you want to go ahead? Comment is that also IRAs, Laura's really talking about the ability to make a lifetime gift to a charity. Yes. From the IRA, which is, we're hoping that the law gets extended this year. But also, a charity is a wonderful beneficiary of an IRA upon death, and you avoid the income tax consequence, which is very high because they're also included in your estate, so you have kind of a double taxation, and also you get a charitable deduction upon death.
But jump in. Do you have anything else to add, Ron?
That was exactly my point. Very good.
Yeah.
Well, and flipping back to the IRA distribution, as I understand, it's only useful for regular IRAs and Roth IRAs, not simples nor SEPs.
That's correct.
Yeah.
Ron, I've heard about private foundations and donor-advised funds. What's the difference, and how do I determine which is best for me?
In a donor-advised fund, this is an opportunity for the donor to participate. You make the contribution to your favorite charity and literally set up a fund that the family then can come to that charity who has created it and suggested ways in which they want the funds distributed, whether it all be to one charity or to several charities and how much per year. But it's an opportunity. For instance, I dealt with a lottery winner, and we put a lump sum in to a donor-advised fund because we wanted a large donation that upfront year. But as far as divvying it out, the advisor is going to be divvying it out, did divvy it out over a period of years. I'll let Ms. Cohen talk about then the...
When you are working with charitable organizations, and I apologize, I'm going to ask Laura, are there donor-advised funds available through the KJZZ plan given?
There is through Arizona
Community Foundation. So Laura mentioned the Arizona Community Foundation, and I will use that as an example. The Arizona Community Foundation helps a lot of smaller charities manage their plan giving because they have the resources to do it. And the funds that can be set up there, and they can be set up through KJZZ, they are funds that allow the donor over time, I think as Ron said, to make specific donations to different charities. These charities have to be approved by, in this case, the Arizona Community Foundation. But what is interesting about a donor-advised fund is that it is like making a charitable contribution to a 501c3 organization, because that's what these community foundations are. So when you're making the donation, you can make the donation for up to 50% of your adjusted gross income. And I'm going to just kind of keep in the background that the alternative minimum tax is always a factor when you are making charitable contributions and donations. But and I want to mention one other thing is that if you cannot use up all of your charitable deduction in 1 year, you do have a 5-year carry forward. So they are a nice vehicle You don't have the limitations that I will discuss in just a minute about private foundations, and you get to do some selected giving, and even you can provide in the donor advised agreements sometimes that if you die, you can make suggestions and have your family members also be part of the giving, and they can continue your legacy through a donor advised fund.
Steve,
So, we didn't finish though. Do I get to finish?
Okay, sure, we can go with that.
Okay, that's donor advised fund. Private foundation is a subject that you could, go to a seminar for 8 hours on and probably not learn everything there is. It is really a way to create either a trust or a corporation that is an exempt nonprofit. Excuse me. It's also, it can be a 501c3, which is your general charitable organization that provides for education, health, public assistance, promoting science and the public good. It's a very broad use. But the difference is that you're not fundraising from the general public. You are putting the money in privately. And there is a lot of work that goes into maintaining a private foundation. But for people who are wealthier and they want to get the tax benefits from both an income tax point of view and an estate tax point of view of having a private foundation, it is certainly something that they can do and create a gifting legacy again for their family. So when you form a private foundation, you have to make an application to the IRS to get your tax exemption. So there's work and time and cost involved in that. You have to generally file a return each year. There are some exceptions for smaller foundations. That's your Form 990. And there's requirements that once it's tax exempt and it's earning its income tax free, there's requirements that you have to distribute a certain amount each year. So in general, there's a 2% excise tax on the net investment income of a charitable foundation, and the requirement is that you distribute 5% of the private foundation's investment assets each year, and if you don't do that, the next year you're subject to a 30% tax. So you have a lot more complications. You have to have a board of directors. You have to have succession for your board. You can use your foundation to leave a portion of your estate to upon your death, and again, it qualifies for the estate tax charitable deduction. But one of the big limitations compared to a donor advised fund is that if you put cash into it, you only get a charitable deduction. This is a general rule of 30% of your adjusted gross income, and if you put investment assets in, it's 20% of your adjusted gross income.
And this would be mostly for wealthy people?
It's mostly for wealthier people.
Is there a range where you would say you're getting into the category where you might consider this?
I think I see people who use these generally who have a taxable estate, because if they have enough income to do gifting during their lifetime so that they can take advantage of the charitable deduction, and I also have to qualify this by saying that they're really charitably inclined people, that they can get assets into the private foundation and get them out of their estate for estate tax purposes, and then they can grow in the foundation subject to, there's lots of rules that apply to charitable foundations and the types of investments you can make, and there's self-dealing rules, and there's penalties if you don't operate them correctly. But if you do it correctly, you can have these assets grow tax-free during your lifetime within the foundation. But then also upon your death, you get a charitable deduction for anything that you contribute upon your death from your estate.
Just to note also that you can access a recorded copy of tonight's presentation at KJZZ.org. Steve, what role do my lawyer, CPA, investment advisor, and charitable organization play when I'm ready to make a sizable charitable donation?
That's a good question, because they're all very important roles. And they should all be coordinated. Speaking from the standpoint of an investment management firm, having that planned gift, as Ronna discussed earlier in the broadcast, you know that you're going to make a gift. If the investment team knows you're going to make a gift as well, then you can plan the portfolio. We go back to that strategic securities gifting we talked about, and that is you get to use the market fluctuation to your advantage. For example, if take this past tax year, people that had investments in possibly the Chinese market, that market went up quite rapidly through February, March, and mid-April. That was a wonderful time to reallocate your portfolio, give away some of the shares in that particular sector that have really appreciated, take it out of your portfolio, and use that fluctuation to your advantage. It changes the asset management and the portfolio management from having a taxable sale to a gift. And instead of making a gift at the bottom of the market, you make a gift at the top of the market. It's all about managing cash flow and using that planned nature of the gift to your advantage.
Dennis, if I might add,
Sure.
Tonight what you have here is the various members of the Central Arizona State Planning Council. And one of the things that we try to do each month in our meetings is to meet with each other and talk about issues that are facing each other. And I think it's extremely helpful to have a team approach. As the CPA, he or she knows certain things about the client situation that I don't know as the attorney. And I think that applies to all of us as a team. You know, it used to be we thought of the trust officer, the CPA, and the life insurance person, and we really expanded it now, where you'll bring in a real estate advisor, you'll bring in a financial advisor, you'll bring in real specialties because they can add to that team approach. And by doing all this, our whole goal, of course, is to meet the client's objectives in the best way that we can.
Excellent point.
I've also found when doing some planning for larger estates that the charitable organization itself can be very helpful. And I find that people generally give to an organization because they have a passion about that organization. And sometimes they give, and I think we touched on it a little bit earlier, sometimes part of their motivation is to save taxes either during their lifetime or upon their death. But sometimes people with smaller estates don't have those same motivations, and I think we've all seen it. I mean, we've also seen people that don't have children, and sometimes they just don't have anybody to leave their estate to, and it can be, you know, really helpful for them and provide comfort to them for them to get involved with some of the plan giving professionals who are with the charitable organization, and they kind of help them. And I'm sure sometimes, Laura, you must feel like you provide some therapy,
yeah.
a lot of hand-holding and a lot of therapy for people, because these are difficult decisions. And I think that, you know, I think Ron makes a really good point, because we can't do this on our own. We are a team, but we're dealing with very sensitive issues, and we have to really you know, empathize with our clients and help them make decisions that are going to be meaningful for them.
Well, and sometimes we don't even know the listener or member to KJZZ or KBOC or other charitable that have us in their will or their estate plan. I worked for an organization at one point and was notified that we had inherited a house. Not only a house, it was a house full of furniture.
Oh.
And of course, that is something one has to turn over very quickly, which was very good, because the charity needed the household items, the furniture, etc. So it worked out perfectly from that standpoint. The house sold readily, and the person that had willed it was in his will, had left enough specifics in the will as to how he wanted it used for this particular organization. So that's good. If we could get them to the table or get them to contact us with what their passion is, what their interests are, what they see for the future, or what they want to maintain. Many of our KBOC listeners for classical music want to maintain classical music for the future. So that's why they seek to give us from their estate plans, as well as their membership with our membership drives.
We keep hearing, Laura, about scams where most of the money raised doesn't go where it's supposed to go and doesn't go to those people in need. How can we know that the charitable contribution will be used the way it should be?
I recommend to people every year and every time I have an opportunity to check out, particularly now that we have the World Wide Web. There are 3 websites that are very, very good, and you can go in and ask about any organization you want to. One is charitynavigator.org. The second one is guidestar.org. And the third one is probably the oldest one around. It's CharityWatch.org. And these are specific websites that vet charities. For instance, KJZZ was vetted last year by Charity Navigator and received a very, very high rating as a up-and-coming organization, public radio. We held to very rigid standards in terms of our operation, where the money went, et cetera, et cetera. And I just recommend to people to just check out the organization. Or go, if it's a smaller organization in your hometown or in the area, pop in, look them over, ask to speak to the person in charge of collections and of money, ask to speak to the administrator, ask them if they have an annual report, ask them to see their tax. They have to file as a nonprofit, so ask them to see that. And those things should all be open and appropriate.
And just as a note, the IRS does have a site that also lists the charities, and that you can find the Form 990 filings.
Yes.
Was that Select Check, I think, is IRS Select Check?
I think so.
I think that's what it is, but GuideStar will also lead you there. GuideStar has the IRS one right on its site.
Brad wants to say something.
Go ahead, Bob.
One of the things, Dennis, sometimes my clients don't remember, though, when they want to designate the funds that they're going to be leaving the charity in a specific way, and they get upset when they want to use it for the lights and other miscellaneous. But what we all have to remember is we've got to keep that door open, and charities love it when they receive non-restricted funds. Mm-hmm. It's okay, obviously, if you've got a specific love that you want that charity to follow, but it's certainly welcome to have funds that are not designated, because operational money is what keeps that door open so that charity can serve its purpose.
What about making a gift after death? My father passed away, for instance, and due to his personal and health situations, he or his estate is subject to a minimal tax rate. Are there other ways to make desired gifts and get meaningful tax benefits back?
Well, that one is a little more difficult, because once Dad died and he did not provide for a charitable bequest in his estate planning documents, the beneficiaries and heirs can't go make one on his behalf. So unfortunately, it sounds like Dad should have had some planning, some additional planning, if he had a taxable estate and they wanted to minimize taxes. Because I think just to mention rates right now, everybody has an exemption from estate tax, which in 2016 is going to be $5,445,000 per person, which means that it is, I gotta do my addition correctly, 10 million, you guys help me, 10,890,000 per married couple. So for there to be an estate that is taxable, if it's planned right, it has to be above that amount. So it's unfortunate for this family, but they are going to have to pay some estate tax, and if they want to honor Dad and do some of their own charitable gifting, they're going to have to do their own planning.
Yeah, because that could be a way around, is to make the gift from the heirs, and take the deduction at the heir level, and just take the inheritance from Dad themselves, and where in the case where he may not get a tax benefit for a contribution to anybody, the heirs certainly may, if they're still working in a high enough tax bracket.
Well, and some states do not require taxation from if you're an heir.
Yeah, but that's state level.
At state level.
Arizona does not have a state estate tax.
Right.
We used to, but it was tied in with the federal.
Right.
So the net effect was zero. So we don't have one here.
Right. Well, we would be talking about federal tax.
Correct. Federal. Right. So federal, there are some states that still do have an estate tax. So, Ron, do you have any other thoughts about?
Well, taxation obviously is an issue anytime you have clients in, but there's been a recent study done by a U.S. trust company that shows that the number one reason people give is not for taxation purposes. It's for the cause, or it's because the person that solicited them, they knew them. So it used to be, more of a taxation selling issue. Mm-hmm. But charities are finding right now, if they do a relationship, and I encourage every board that I'm on, every plan giving committee I'm on, remember folks, it's a relationship. And once you build that relationship, the opportunities then will be much greater for donors out there to understand what you're doing and why you're doing it.
Yeah, I want to make a comment just in the planning arena, that because of the value of the estate that is not subject to estate tax, and I'm sure, Ron, you see this in your practice too. When our exemptions were much lower, we did a lot more planning to save estate taxes. And what I didn't mention is that the tax rate graduates pretty quickly, the estate tax rate, but once you hit it, you're pretty quickly you're at 40%. So if you're making a charitable deduction of let's say $100, you're saving $40 of estate tax, and you control that $100 is controlled by the charity or a foundation. But don't you find so much more of the planning today is really more geared to personal desires and wishes than it is to the estate tax? Even though we do have clients that do have estate tax issues, that you can have a very nice, client that has a good business, and between husband and wife in a community property state, they're still under the exempt amounts.
Most definitely.
Yeah, and I just think how we counsel them.
I was trying to talk for a couple of days about the needy lawyer fund, but it didn't go over well.
Didn't go over well. But I just think how we counsel our clients is different than what it used in some cases when they make their decisions.
Well, as a reminder, there's a group of professionals available to answer and to take your questions for the group. You can reach them at webinars@kjzz.org. You can use your chat box. What type of gift qualifies for charitable contribution deductions, and how much will my charitable contribution save me in taxes? Ron, Beth?
Do you have your cheat sheet?
There's all kind of right. I don't know how you want, Beth, you want to start it?
Yeah, almost anything qualifies. I have been on enough boards of charitable organizations where there's, you don't look at it just from what the donor is giving. You look at what the charity will accept. Because we had a lot of problems in, I don't know how far we want to go back, but there was a lot of charities that got stuck with properties that had, for example, environmental problems. And so charities really became much more focused on rewriting their gift acceptance policies so that they could reject some property if it wasn't something that they felt that they could either liquidate quickly. Because I mean, it's wonderful to get a beautiful piece of artwork, but if you can't liquidate it, it's not going to do the charity any good. And if you get the title to a piece of real property that has environmental issues, you're in the chain of title. Your charity is there, and you have exposure. So I think that it has the charities have become much more diligent about defining. I mean, does every charity want an old car? No. You see these ads and billboards that will take your old junker and do whatever with it. So obviously charities like cash. That's always a good thing. Another good thing, and it's really relatively inexpensive, is for someone to get a life insurance policy. And they can transfer the ownership of the policy to the charity and make a donation every year to pay the premium. And it's, let's say, you get a $100,000 policy and you have a few $100 a year premium, that's a really inexpensive way to benefit your charity. We talked about stock earlier. Usually charities aren't going to take, they like marketable securities because they can sell them right away. If you do planning where you're using stock in a closely held business because you're selling your business, there's a lot of intricacies that go with this, is that a charitable remainder trust might be a good vehicle to use in your planning prior to the sale of your business. Somebody else want to add a few more things?
I have to take issue with the cars because we have a car program.
Oh, do you?
And it's
Okay, I'm sorry.
with KJZZ, and it's extremely lucrative.
Oh, I'm sorry.
I have encouraged some people that have called me to go ahead and put the car in their estate, and all they have to do is put the vehicle number as part of it and make it out to
Do you just have somebody, do you work
We
with
work
somebody
with
who liquidates it right away
Exactly. Exactly. So that has become quite a good opportunity
for you?
for
Okay.
us.
Well, that's good to know.
I know. And we get those old clunkers off the street.
Yeah, but you have to go back to, if you're doing this for tax planning purposes, for income tax planning, the type of property that you contribute does impact how much of a charitable deduction that you get. Again, if it's cash, we're just talking outright to a 501c3 charity. We're not talking private foundations here. And again, your 501c3 will include a donor advised fund. That rate is 50% of adjusted gross income. And if you have inventory or depreciable property that's used in a business, you can only deduct the amount of its cost. But again, your contribution is you have the 50% of AGI limitation. If you have investment property that you've held for less than 12 months, again, you're contributing it at cost basis, and you are subject to the 50% of AGI limitation. And if you have long-term capital gain property that you've held more than 12 months, again, this can be marketable securities, it can be real estate, any type of investment property. You're contributing at fair market value, and your amount of your contribution is limited to 30% of your adjusted gross income. And my suggestion, there's a few other categories, but my suggestion is if you do this, that you contact your CPA, see how this is going to impact you, because if it triggers the alternative minimum tax, you might not have any savings at all. And that's just a trap that you don't want to fall into.
And if people don't have CPA or estate planner or an attorney that they're using regularly, Steve, what would you what would you suggest for them to do in terms of contacts?
I think the organization, the Central Arizona State Planning Council organization, is a great go-to tool. One can go to the website. It's very simple. It's CAEPC.org, and there's a list of professionals in that organization. You can search by firm name, by last name, by specialization, and find a couple people that are good quality.
What about donating my home and reserving a life estate? Somebody wanted.
Ron, do you want to do that one? Do you want to respond to that one?
Actually, if I could, just deviate.
Sure.
I wanted to add something, and I'll come back to that real quick. Because an issue that's coming up more and more, because charities are out there talking to people about it, has to do with tangible personal property. And there's a difference on what type of tax deduction you're going to receive, depending on whether that charity can use the property that you wish to donate. Mm-hmm. So in other words, if you donated a painting to the Phoenix Art Museum, that's an item, hypothetically, they're going to be able to use. And so the deduction is going to be the fair market value of that. But if you gave that same painting to Dogs Unlimited, that you've got to go back then to your cost basis. So please be careful, each of you, as you're donating, to make sure what type of property, if you're going to give tangible personal property, can that charity use it? And if not, you may want to contribute that particular item to a charity that can use it if you're after a specific tax deduction. That's a big issue.
That is.
Okay. Now, a life estate, yes, you can reserve a life estate in that home that you want to donate. And it also depends on the cost basis. You're going to make sure it has a fair market value. And then charities have become much tougher on the acceptance of real estate. I know I've been involved in writing acceptance policies for charities. I generally make sure that, particularly if there's an environmental issue, I want to make sure that environmental issues are researched. I want to make sure we've got a clear title. There's different elements of whether that property has a mortgage against it. But if you donate your house, there are ways in which you can reserve the right to live in the house, and then you can make a donation then to that charity to pay for the taxes and the insurance and the upkeep. You're going to be responsible for general maintenance on that property normally. And it depends on what you're trying to do and what kind of arrangement you make with that charity is what the deduction's going to be.
Neighbors facing an unexpectedly large medical bill. Can I help the family and still receive a tax deduction?
That's a toughie.
That's a toughie, because usually when you're paying for medical bills, because this is an income tax question, and when you're paying medical bills and you are trying to receive a deduction, it's for yourself and your dependents. And we actually, before our presentation, we were kicking this around a little bit, and I don't see how someone can get a tax deduction for paying somebody else's large medical bills. And the problem you've got when you're making and let's say you go, okay, that's the income tax side. And then so we're kicking around what happens from the charitable side. So if they're at a hospital, hospitals have foundations and you give, well, can you make a gift to a hospital and say, I want this money to go to care for John Doe? And the answer is no, it won't qualify as a charitable gift. You cannot designate that it be used for a particular person, because a public charity means public charity. It's the monies go for the public good and to help maintain the purpose for which that charity has been formed. So I think that if it's kind of a well-meaning or there's a good meaning to someone wanting to try to do this, it's honorable, but I just don't think they would be doing it for a tax benefit.
It sounds like it follows the same lines of a private school contribution versus tuition.
Right.
and you can't assign your contribution to one
tuition.
person's tuition.
Exactly.
Yeah.
And that's the way the hospitals see it. There are some unusual things coming up with the crowdsourcing in terms of donations for particular individuals. That's a popular thing. Although, say they are collecting monies and it's at one of the local banks in town, that does not necessarily mean that it's a 501c3 organization. So they maybe just have a charitable fund that they're going to give to the family for their expenses. But that is not the same as a 501c3 for a charitable tax donation. And hospice would be the only other one that people many times give to, but again, it can't be allocated for a specific person.
Could the neighbor set up a foundation, for instance, and then you contribute to that and get a tax deduction?
I'm sorry, could the
neighbor set up a foundation of some sort that you could contribute to and get a tax?
Well, the foundation has to have a charitable purpose. And so if the neighbor sets, there's self-dealing, prohibitions on self-dealing. So you cannot set up your own private foundation to benefit yourself. Donations would not qualify for charitable deductions for that.
What's the most important thing to consider when you're at the point where you're considering a planned gift? What do you need to do?
I'm sorry, the most important, what, please?
Most important thing to consider when you're getting to the point of making a planned gift.
Question. I tell my clients that when you're making that consideration, have you thought about, number one, is it, are there fields of interest? So people will come into me and they'll say, well, Ron, we want to designate certain monies of our estate. We've been blessed. And so I want to understand what they want me to even recommend a couple. Well, I don't want to do that. I want to understand what their fields of interest are. And once they do that, then I say, all right, if you're interested in dogs, have you looked at certain charities here in town? Because we're blessed as an example with that. So have you researched to determine which one meets your specific ideas of how you want that money used? And by doing a little bit of research and talking to people at that charity or talking to members of the board, I think that's important, particularly if it's going to be a significant gift. I think you need to do a little research.
I think it's also important because kind of getting back to the issue of personal planning, that if somebody comes in and they have a family but they want to make a significant gift to charity, I also want to take into consideration with them what the impact of that gift is going to have on their family.
That's an excellent point, because you wouldn't want a gift like that to destroy your family balance and set one against the other. Yes.
Right. And how much is enough to, especially in larger estates, a lot of the discussion is how much is enough to leave for the kids. Because I think as professionals, we've all seen situations where, let's say there's been a successful business and the next generation just runs it into the ground because, maybe grandma and grandpa were very frugal and, they built this fabulous business and they passed it on to their kids, but their kids' lifestyles were just completely, much, much higher, and the business couldn't support it all. So, you need to kind of look at how people feel about their families, how their families may feel about the charities, and make sure you have a good balance.
Long-term care issues have become very prominent in the last 5 to 10 years. The cost of long-term care, you're easily looking in the Phoenix market. You're looking at $7,000 to $8,000 to $8,500 a month. Well, that's significant. And so you think you've got $200,000, $300,000, $400,000 put away for retirement, and you're okay, so you can give to charity. Well, then all of a sudden you realize that if you're there in that retirement home very many years, that's all going to dissipate. So that's why some people who will make very small gifts during lifetime. I just dealt with a client who gave a particular charity $100 a year, but she had no family. And so in her trust, she's put that the charity is going to get half of any remaining balance. So she's really covered herself. So if it used all up in, her long-term care planning, so be it. But if it is left over, will provide a significant gift to charity.
I think that's a good point too. I think, I try to encourage clients to use percentages rather than dollar amounts if there's an issue.
I was just going to say that many times when they call, instead of saying a specific dollar amount, I'll say, well, why don't you consider the whole and just break it up into percentages.
Good point, Laura.
And also I encourage people that are getting ready to do estate planning to make sure they've checked out with their children that this is what they're going to do, and let the children voice perhaps their concerns or opinions early on, so that the person setting up the trust understands what the challenges might be post death. And I have a saying every once in a while, it's kind of cheeky. I say, death and divorce are all about money. I have a friend that says weddings are in there too. So.
Dennis, if you was a potential donor, let me throw a question at you, if I might.
Oh, good.
You like this reversal role there?
No, I don't. Go ahead.
What is your reaction when the XYZ charity sends you a mail piece about, Dennis, we'd really like for you to consider us in your estate plan? But what's your reaction to that?
I think my reaction would be that, I can decide myself where my money should go, and I don't need their help necessarily. So I think that those kinds of mailings would be likely to go in the circular file.
Good. Fair comment. And that's, as being on the other side of the Plan Giving Committee, I want to create a piece that you're not going to put in there. I want you to keep that piece and take it to your advisor to talk about. So you represent you're a typical donor challenge, and we respect that.
And I think, I don't know what it is that pushes you over the hill to donate to that particular charity. Obviously, it has to be something that you're interested in to start with, and just a letter out of the blue isn't necessarily going to accomplish that. So I guess for the charities, it would be a good idea to be able to target their messaging to people who actually might be interested in doing that.
Well, that's where relationships come in.
Yes.
And that's where we do have target audience with KJZZ and KBOC and other charities have their own target audiences. But again, just kind of flooding the mail with materials doesn't really do anything.
No.
I probably have 60% of what I do in a year is more information. I just provide information. I may not see any of that back. It's just information that people have requested. And I'll call and I'll follow up, but I'm not going to nag. As a charity, that's not.
But on the positive side, if you do see some of it back, it's worth it.
It's great then, yeah. And sometimes like I said earlier, we have no idea the hidden members that have decided to put us in their will or their estate plan, and all of a sudden this money comes in and it's just like singing the hallelujah chorus.
Something to keep in mind too as we approach year end, we brushed on the potential of gifts from IRAs, and that law is not passed, been re-upped yet, and securities gifting and things like that. There's, on the operational side of things with the custodians, they're going to need lead time. And if you sell a stock, it takes 3 days for the stock to turn to cash, and you got at least a couple days after that to get paperwork in. Mm-hmm. And the later people wait, the longer that logjam gets at the custodians, and you may or may not get your gift out in the tax year. So if you're going to make a gift, start that process earlier as opposed to later.
if you're going to make a gift of the stock itself, do you have the same lead time?
Yeah, it could be because the custodians will get the letters of authority, and they'll get them from hundreds and thousands of people towards the end of December, and they've got to process those things one by one by one. So it just takes time to get through the system.
So then can you make a gift that, you pull back at the end if the law doesn't get passed
Well, for the IRAs, if you were thinking about the IRAs and when you get close to year end, I'm thinking if you don't have the $100,000 in cash and that's what you want to give, get it in cash. What's it cost? $8 or $9 in the trade commission? It's a tax-free trade anyway. So it's $8 to get prepared to have the cash to sign the letter and get it going. Small price to pay.
All it has to be is out the door that particular, of the very last day of the year.
Right, and
by midnight.
And the IRAs won't release money unless it's a cleared fund.
Exactly.
So the trade's got to clear.
So an advanced trade agreement is suitable.
Well, we are blessed here in town. We really have some excellent advisors. We have excellent charities. We are a good citizen community. I really believe that, Dennis.
Okay. Well, that concludes our webinar on planned giving. You'll be able to access a recorded copy of this discussion on kjzz.org. And as a reminder, our experts will be available to answer your questions until 8 tonight. Thank you.